What are shares? In order to understand what shares are, we first need to go back to know how companies operate. Let's imagine a new construction company. The owners might decide to sell part of the business to the public in order to raise funds to expand business operations. When a company decides to go public, it conducts what is called an initial public offering or IPO. This is the period where the company invites investors to buy shares from the company for the first time and before it lists on the stock exchange, like the BSE. Shares are financial assets that represent part ownership of a company. They're also called stocks or equities. But what are the benefits of share ownership? Firstly, as more investors purchase shares in the construction company, their investment helps the business grow. When the company makes a profit, it may choose to distribute a portion of those profits to its shareholders in the form of dividends. However, sometimes the company might choose to retain its profits to fund expansion of the business's operations, which can, in the long run, contribute to even further growth, which can lead to even larger dividends. So, shares can provide a regular income for shareholders. Alternatively, as the company grows and becomes successful, more and more prospective investors may see an opportunity and rush to buy stocks. As demand for these stocks increases, so does their price, which raises the value of the company's stocks already owned by its shareholders. This is capital growth, the difference between the current market value of an investment and the price it was initially purchased for. Shareholders may choose to sell their stock, and the difference is the financial benefit that is derived as profit at the time of sale. Another benefit of share ownership is having a say in how the companies run. Shareholders are involved in the running of the business by way of appointing directors responsible for the day-to-day operations of the company. They do this by exercising their right to vote on resolutions requiring their consent during a company's annual general meeting, or AGM. Now that we've covered the benefits, what are the risks of share ownership? The primary risk is that of a company underperforming or even going under. This puts shareholders at risk of losing their investment. However, there are ways to mitigate this risk, like selling stocks in time to make back an initial investment, or choosing to weather the storm before the company becomes successful again. Alternatively, investors might also choose to diversify their investment to cushion any losses. Ultimately, before deciding to purchase shares, make sure you sit down with your broker to plan out the different kinds of stocks you wish to purchase in line with your financial goals. Currently, the BSE has listed companies that represent different sectors of the economy, such as mining, property, retail, financial services, tourism, agriculture, and many others. So it's imperative to understand how these work before choosing to buy stocks. Further information can be accessed from the BSE Investor Handbook that you can download from the BSE website. Botswana Stock Exchange, your partner in wealth creation.